Well, good afternoon. Happy Friday. Happy Halloween. Mark Milam here, your mortgage professional. So, the big news this week and the spooky news as we move through the second half of the week is that the Federal Reserve did exactly what we expected them to do on Wednesday at 2 p.m. Eastern Time. They cut the Fed funds rate by 1/4%. Now, just to be clear, this is not a mortgage rate. This is an overnight lending rate to banks and financial institutions. And because these moves are pretty well telegraphed in advance by the Fed, the mortgage market had moved in advance, not just of this meeting, but of also the December meeting that's coming up in about 6 weeks or so. So it's important to note that at the last Fed meeting back on September 17th, we got the Federal Reserve dot plot projections for where they anticipate the Fed funds rate to be at the end of 2025. And those dot plot projections said, hey, after the cut on September 17th, we anticipate two more quarter point cuts. Well, we got one of those this past Wednesday on October the 29th, which leads everyone to believe that you would get the last one at the very last meeting of the year, which is somewhere around December the 10th. We would get that second cut. Not so fast, said the Federal Reserve chairman, and that sent equities spiraling down. The stock market gave up about 340 points worth of gains, actually finished down on the day. It also sent mortgage rates up. Let me flip the screen around. I'll show you just an article here that Powell warns at the meeting on the 29th not to count on a December rate cut just yet, that the Fed is extremely divided and further cut is not a foregone conclusion, far from it. So that's really interesting because 6 weeks ago, when they met, the majority of those members said that they would have that level of cut by the end of the year. We know we didn't get any economic reporting. We haven't gotten any economic reporting since the government shut down on October 1st, save one consumer price index report that we got so the government could establish cost of living increases for Social Security. And that consumer price index report actually came in below expectations. That would tend to lean towards greater confidence of a Fed rate cut. But the Fed chairman saying, not so fast, my friends, this past Wednesday, and that was not good news for mortgage rates. Let me give you just a quick context on this. I want to flip the screen around and show you what happened in the world of mortgage-backed securities. And I want to remind you that the green days are good days. These are the days we want. We want mortgage-backed securities increasing in value because that means the associated yield or the interest rate is coming down, right? So green days are good days. Red days are bad days. Red days where the value of these securities are dropping, that means the associated interest rate is going up. Look at what's been happening to mortgage-backed securities since October 1st, since right around right here. We have been on this nice steady increase with improvement to affordability, lowering of mortgage rates. And why has this happened? It's funny, I was at the Mortgage Bankers annual conference in Las Vegas talking with my business partner about this. And it's funny that when you strip out all of the economic data reporting, the market has tend to found this sort of equilibrium and this stable trajectory that's led to improved affordability for mortgage rates. I'm kind of grateful that we're not getting a lot of economic reporting. I certainly don't want to see the government shut down and people without jobs, but I'm grateful for sort of the respite in economic reporting. And then we get to this Fed meeting and the Fed decides to tell us that, hey, that quarter point rate cut you were counting on December because we told you to count on it, don't count on it. It's not a foregone conclusion. And we saw mortgage-backed securities sell off and mortgage interest rates worsened on the day, maybe an eighth, maybe a quarter of a point, depending upon what note rate. And today we find ourselves relatively flat here as we move into Halloween. So that's what's been going on. If we take a look at what happened with futures traders, well, we went from projecting a Fed rate cut to the tune of around 91% probability in December. Now we're at about a 63% probability that the Fed is going to cut the Fed funds rate. So still greater than 50%, but far from a conclusion, a certainty that the Fed will do that. One other component of the Fed meeting that I just want to highlight was the Fed announcing that they're going to stop quantitative tightening on December the 1st. Let me show you a quick graph that's going to help illustrate this in case you're unfamiliar. So this is quantitative easing. It's hard to talk about quantitative tightening without talking about quantitative easing. And starting in late 2008, the Federal Reserve began buying treasuries and mortgage-backed securities to stimulate the market and to drive down interest rates. They did it here at QE1, quantitative easing 1. They did it again here with QE2. They did it again right around the end of 2012 with QE3, and they kept loading up on their balance sheet with treasuries and mortgage-backed securities. They started to taper a little bit, and then the pandemic hit. We had COVID, and we entered into a turbocharged round of a quantitative easing where the Fed was buying mortgage-backed securities and treasuries until we exited the pandemic in 2022. And then they began right here what we'll call quantitative tightening, which is where they allowed these treasuries and mortgage-backed securities to mature and run off their balance sheet, right? And that has put upward pressure on interest rates. Well, as the Fed announced on Wednesday that they're going to end quantitative tightening, you would think that would be good news for mortgage rates, right? The Fed is going to stop rolling off this stuff off their balance sheet, which would introduce some demand for mortgage-backed securities, which should drive down interest rates. But then they hit us with the left hook, and they said that, hey, while we are going to stop quantitative tightening, we're going to reinvest any and all proceeds from maturing mortgage-backed securities, not into new mortgage-backed securities, but over into treasury bills. And that was not great news. We really don't want to see the Fed reinvesting any of these proceeds into treasuries. We want to see them supporting the mortgage-backed securities market. That's what's going to help drive down interest rates, at least somewhat, and help improve housing affordability. Well, that didn't happen either. So we got the big punch to the jaw with the December rate cut not being a foregone conclusion. And then we got a little bit of secondary body blow of saying, hey, yeah, we are going to do what you thought with quantitative tightening. We're going to stop it, but we're not going to be reinvesting anything that rolls off into mortgage-backed securities. We're going to divert that over into treasuries. So mortgages got a little bit of a double whammy this week. And while we're certainly off the best levels of 2025, mortgage rates are still good as we move into the Halloween weekend. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com. Have a good weekend.